You have exactly 48 hours left. That is really all the time remaining on the clock before we hit a major turning point. We are staring down the barrel of a decision by Jerome Powell that has the potential to launch the price of gold to levels we have literally never seen before, possibly hitting $5,000 or even going higher than that. This isn't just me guessing. When you look at the recent reports coming out, you have heavy hitters like Jamie Dimon, the CEO of what is widely considered the biggest bank on the planet, suggesting that gold prices could actually climb as high as $10,000. He isn't talking about this happening in 20 years. He's talking about the environment we are living in right now. And the scary part is, he is definitely not the only one thinking this way. You have massive institutions, the ones that usually run the show, Goldman Sachs, Bank of America, and Vanke, reportedly putting out forecasts that look very similar to this. But here's the thing. There is a specific reason behind these numbers that they aren't exactly broadcasting on the evening news. There is something very specific that has been going on for about 13 months in a row now. It is a trend that explains why these crazy high price targets aren't just people being hopeful, they might actually be unavoidable. I am going to break down exactly what this factor is for you, but first, you really need to wrap your head around the impossible situation the Federal Reserve is stuck in at this very moment. Come December 10th at 2 p.m. Eastern Time, the Fed is going to make an announcement, and that is the moment everything shifts. Now, before I go further, I need to be clear. I am not a financial advisor. Nothing I'm saying here is financial advice, and I don't work for any of the people or banks I'm talking about. I am just breaking down the educational analysis based on information that is out there for the public to see. Right now, as you are reading this, the Federal Reserve is reportedly staring down one of the worst case scenarios imaginable. Think about inflation. According to the recent data we have seen, inflation is still sitting above their 2% target, and it has been running hot for roughly 4.5 years. Then you have to look at the job market. The analysts who watch the markets are suggesting that our unemployment numbers are starting to crack faster than they have at any point since around 2008. And you remember what 2008 felt like. So the Fed has to make a choice, and it's a brutal one. They can cut interest rates, but if they do that, they risk pouring gas on the fire and fueling inflation. Or they can hold rates steady, but then they risk wrecking the job market even more. There is no easy button here. It is just a series of painful trade-offs. This impossible choice is exactly why we have seen gold prices reportedly surge by about 60% just this year alone. When you talk to financial historians, they will tell you that we have seen this kind of setup happen twice before in our modern history. And in both of those cases, gold didn't just go up a little bit, it absolutely exploded. I want to walk you through that pattern so you can see it for yourself. Let's go back to August 15th, 1971. That was the day Richard Nixon closed the gold window. For the first time since the end of World War II, the US dollar wasn't backed by anything tangible. It became just paper, backed only by promises. Most people at the time didn't even realize the magnitude of what had just happened. They just kept living their lives, trusting the system. But the smart money? They saw it immediately. In 1971, gold was trading at approximately $35 an ounce. By the time we got to 1974, it was around $195. Fast forward to 1980, and it was close to $850. That is not just a market rally. That is a currency collapse that is dressed up to look like a gold boom. We are talking about a gain of roughly 2,400% in just 9 years. And you have to understand this didn't happen because people suddenly fell in love with shiny rocks. It happened because they lost faith in everything else. They lost faith in the dollar, the government, and the system itself. When that trust disappears, gold is the only honest thing left. Now, let's fast forward to 2001. Gold was sitting at approximately $271 per ounce. Nobody wanted it. They called it a barbarous relic. Everyone was saying that tech stocks were the future. They called it the new economy. Alan Greenspan, who was running the Fed, had a plan. He cut rates from around 6.5% down to 1% over the course of 3 years. They flooded the system with cheap money. We got a housing boom, an explosion of credit, and it looked like everyone was getting rich. But then 2008 showed up. Lehman Brothers collapsed. Bear Stearns collapsed. We saw the AIG bailout. The entire global financial system almost imploded. And what did gold do? It went from approximately $271 in 2001 to around $1,900 by 2011. That is roughly a 700% jump. This is the lesson. When central banks print money to try and fix the problems they caused in the first place, and when trust in the system starts to crack, the end game becomes obvious. Gold doesn't just rise, it explodes. This brings us to right now, and this is where it gets really interesting. What is happening as we head into 2025 could make those two previous periods look mild because this time we might have both of those triggers happening at the exact same time. Gold is currently trading at approximately $4,212 per ounce, up roughly 60% this year. Reportedly, This is one of the best annual performances we have seen in decades. But you have to look at what is happening underneath the surface. The recent ADP reports are suggesting we lost approximately 32,000 jobs. That isn't a gain, that is a net loss. Then you look at the Challenger layoff announcements for November. If you look at the year-to-date numbers, layoffs are reportedly over 1 million, which is up approximately 54% according to some estimates. Recent surveys are suggesting that around 40% of companies laid people off in 2025, and some 60% are planning potential cuts for 2026. You cannot call this a healthy economy. This is an economy that is flashing serious stress signals and the fundamentals are getting weaker. And yet, at the same time, inflation is still reportedly hanging around 3% according to recent data, which is actually up from approximately 2.3% back in April. Why is it going up? Analysts are pointing to things like tariff policies, supply chain messes, and energy costs. Here's the scary scenario. More tariff measures might be coming in 2026. That means inflation is not going away. It could actually be speeding up. So the Fed is trapped. They are completely, utterly, hopelessly trapped. If they cut rates, they risk fueling that inflation. If they hold steady, they risk crushing the job market. There is no easy escape door here. The meeting on Wednesday is expected to be one of the most divided sessions the Federal Reserve has had in modern history. Some economists are predicting there will be at least 2 people voting against the majority, maybe even 3. The last time we reportedly saw 3 dissents was around 1992. That tells you how broken the consensus is right now. This division isn't just a glitch. It is a symptom. It is a sign that something much bigger is breaking beneath the surface. And I am about to show you exactly what that is. Think back to approximately 13 months ago. That is when China reportedly started buying gold. And according to all the reports we are seeing, they haven't stopped. Not for one single month. They have been buying for 13 consecutive months. The reserves are now reportedly sitting around 74 million troy ounces, which is worth an estimated $300 billion or more. And it isn't just China. Turkey is doing it, Poland is doing it, India is doing it. Central banks all over the world are reportedly buying over 1,000 tons of gold every single year. That is roughly double their 10-year average, according to market analysts. This isn't just regular investing. This looks like preparation. Preparation for what? It looks like preparation for the potential end of the U.S. dollar's dominance. Look at the U.S. national debt. It is approximately $38 trillion. Just 1 year ago, it was around $36 trillion. That means we added roughly $2 trillion in debt in just 12 months, and it appears to be accelerating. The projections from the Congressional Budget Office suggest we are going to have $2 trillion deficits every year for the foreseeable future. Meanwhile, foreign central banks reportedly appear to be slowing down their purchases of U.S. treasuries. They are seeing the same things that analysts at huge institutions like JPMorgan are suggesting. They see potentially unsustainable debt levels, political dysfunction, and endless money printing. When foreign central banks lose faith in U.S. treasuries, they need somewhere else to park their savings. They need somewhere safe, somewhere neutral, and somewhere that doesn't depend on any single government's promise. That place is gold. Industry analysts have described this trend clearly. This accumulation by central banks reportedly marks one of the strongest streaks of official buying in modern history. This isn't just a passing trend. This could be a structural shift, a total realignment of the global monetary system. And it is happening right now. So let's get tactical about what this means for price. The current price is approximately $4,212. If gold breaks through the level around $4,264 on Wednesday after the Fed makes their announcement, the door could open up to approximately $4,181, which is near the all-time high. And if it takes out that level, some analysts suggest there is potential for a run toward $5,000. Because once you get to that point, it isn't just about technical momentum anymore. It becomes psychological. It becomes FOMO, fear of missing out. It is big institutions realizing they don't own enough gold and scrambling to catch up. But there is something even more explosive happening in the mining sector that could potentially amplify this move by 2 or even 3 times. I will explain that in exactly 60 seconds. First, you need to understand what reportedly ended just recently on December 1st, 5 days ago. The Federal Reserve reportedly ended quantitative tightening. For approximately 2 years, they have been shrinking their balance sheet, draining liquidity out of the system to fight inflation. They stopped. And if they cut rates on Wednesday, they aren't just stopping the tightening, they are reversing course. That means more money, lower rates, and easier conditions. Historical patterns suggest that every single time this has happened in the past, gold has rallied. Every single time. When you combine that with approximately $38 trillion in debt, inflation that is stuck above target, uncertainty everywhere in geopolitics, and central banks reportedly shifting away from dollars to buy gold, the confluence of events appears unprecedented. According to industry commentary from analysts like Ryan McMillan at Merkle-Tree Capital, market observers believe conditions are set for a potential rally, with the rate cut possibly serving as the spark. It's not just that it might rally. Industry experts suggest the market is positioned to rally. Now, here is the explosive opportunity that almost nobody is talking about. Gold is up roughly 60% this year, but do you know what gold mining stocks are reportedly up? Approximately 125%, according to sector indices. These companies are seeing record profits and record cash flow. And unlike the bull markets we have seen before, these companies reportedly aren't wasting that money. They are being disciplined. They are paying down their debt and buying back their own shares. If gold reaches $5,000, these miners may not just go up another 20%. They could go parabolic. Analysts at firms like Morgan Stanley and Jefferies have reportedly recommended allocating about 20% of a portfolio to gold. Jefferies reported a target of approximately $6,600. If we go from around $4,200 to $6,600, that is roughly a 57% gain. And if the miners follow that with potential 2 times leverage, we are possibly looking at triple-digit returns. This is why the smart money appears to be positioning themselves right now, before Wednesday, before the crowd realizes what is happening. Because once gold potentially breaks $5,000, there may be no going back. It is December 8th, 2025, and we are 48 hours away from the Fed's decision. Gold is at approximately $4,212. Analysts at JPMorgan reportedly project $5,000 by 2026. Goldman analysts suggest around $4,900. Vank reportedly targets $5,000 by 2030. Recent commentary attributed to Jamie Dimon suggests that gold prices of $5,000 to $10,000 aren't completely irrational given the current market conditions. China has reportedly been buying for 13 straight months. Central banks are accumulating an estimated 1,000 tons annually. The Fed is trapped between inflation concerns and recession concerns. U.S. debt is spiraling out of control. One of the most divided FOMC meetings in modern history is reportedly approaching. This isn't just a prediction. This is pattern recognition. The 1970s showed us exactly what happens when a currency loses its anchor. The 2000s showed us what happens when central banks print money without limits. And now we are watching both of those scenarios potentially play out at the same time. You have the debt explosion plus currency concerns, plus geopolitical uncertainty, plus central bank repositioning. That is not just a bull market in gold. That could be a monetary reset. Wednesday, December 10th, 2 Eastern Time, Powell announces. If he sounds dovish, if he sounds soft and leaves the door open for more cuts, gold could rip higher immediately. If he sounds hawkish, if he tries to act tough and walk back expectations, gold might dip in the short term. But long term, the market structure suggests it may not matter. The underlying drivers appear locked in. The debt isn't going away. The central bank buying doesn't appear to be stopping. The dollar's historical dominance faces challenges. Gold has been money for approximately 5,000 years. The dollar? It has been about 52 years since Nixon closed the gold window. Which one do you trust more? When gold was around $800 in 2022, critics said it was overpriced. At roughly $3,000 in 2024, they said it couldn't go higher. At approximately $4,000 in 2025, they called it a bubble. And now at around $4,200, many people remain in denial. But the major financial institutions aren't in denial. Goldman isn't. China isn't. They appear to see what is coming, and they are positioning themselves accordingly. You have a choice right now. You can watch from the sidelines and just hope it works out, or you can understand the pattern and act accordingly. Because if Wednesday's Fed decision turns out to be the catalyst that many analysts think it is, and if gold really is heading toward $5,000 and beyond, this could be the moment you will look back on with regret if you do nothing. You need to hit subscribe right now. The next video is going to break down what Powell might say, how the markets could react, and which specific opportunities could potentially multiply significantly in the next 12 months. Wednesday's announcement may just be the beginning. The $5,000 gold forecast isn't just a dream anymore. It could be a destination, and we may already be on the road. You have to understand the gravity of the situation with the debt. When we talk about $38 trillion, that number is so big it loses its meaning. But think about the acceleration. Going from $36 trillion to $38 trillion in 1 year is terrifying. That is not sustainable growth. That is a runaway train. And the projections from the Congressional Budget Office of $2 trillion deficits annually mean there is no brake pedal. This is why the foreign central banks are getting nervous. They aren't just buying gold because they like jewelry. They are buying it because they need a hedge against the devaluation of the dollar. When they see endless money printing and political dysfunction, they know that holding U.S. Treasuries is a risk. They need to park their reserves in something that no government can print more of. That is why this trend of central bank accumulation is so strong. It is a vote of no confidence in the current system. And then look at the miners again. I want to really drive this point home because it is where the leverage is. If you have a company mining gold for $1,600 and selling it for $4,200, that is a massive cushion. But if gold goes to $5,000, their costs stay roughly the same. But every extra dollar of price goes straight to the bottom line. That is why we say they could go parabolic. The leverage to the gold price is incredible. If you look at the targets, Jefferies seeing $6,600 is a game changer. That kind of move in the underlying asset would likely send the mining stocks into the stratosphere. And remember, these companies are in better shape than they have been in years. They are paying down debt and buying back shares. They are lean, mean, profit-generating machines. But it all comes back to the Fed. Wednesday is the key. The market is waiting to see if Powell blinks. If he cuts rates into this inflation, he is admitting that he can't stop it. He is admitting that he has to choose the economy over the currency. And that is the signal gold is waiting for. That is the signal that could send us to $5,000. So do not ignore the warning signs. The layoffs are real, the inflation is sticky, the debt is spiraling, and the smart money is moving. You have 48 hours to digest this information and decide what you're going to do. Because once the news breaks, the market will move fast. And you do not want to be the one left wondering what happened. The consensus is broken. When you have Fed members disagreeing this much, it means the path forward is unclear to them. But the path for gold seems very clear to the analysts at JPMorgan and Goldman Sachs. They see the writing on the wall, they see the trap the Fed is in, and they are telling you, with these forecasts, exactly where they think this is going. It is rare to see this kind of setup. Usually, you have one or two things going for gold. Maybe inflation is high, or maybe there is geopolitical trouble. But to have debt, inflation, a trapped Fed, and massive central bank buying all happening at once, that is a perfect storm. That is why this $5,000 forecast is gaining so much traction. It isn't just a random number, it is the logical conclusion of the path we are on. So, take this seriously. Look at the data yourself. Look at the layoffs. Look at the inflation numbers. Look at the debt. And ask yourself, does the dollar look stronger or weaker to you? If you see what the central banks see, then the move to gold makes perfect sense. The clock is ticking. 48 hours. Be ready.